Most people come into the stock market believing that success depends on predictions, tips, or timing the next big move. Over time, many realize that this approach creates more confusion than clarity. The problem is that markets move every day, headlines change constantly, and opinions are everywhere. And in such an environment, even capable professionals begin to second guess themselves, or they hand over decisions entirely without truly understanding what's being done with their money. This uncertainty isn't caused by lack of intelligence, it's caused by lack of process. And that's why my approach to investing starts with structure and discipline. The first step is understanding the underlying business itself. I begin by studying the financial statements, which includes income statements, balance sheets, and cash flow statements over long periods of time. Looking at 10 years of data helps reveal how a business has actually performed across different economic conditions and not just how it looks today. Once that foundation is clear, the focus naturally shifts to cash flows. Cash flows tell us whether a business consistently generates real economic value or not. And when those cash flows show stability and a meaningful trend, then that gives us a rational basis for thinking about the future. Now, if future cash flows can be reasonably estimated, the next step follows logically, and that's valuation. At this stage, the question becomes simple, and that is, what is this business actually worth based on the cash that it can generate over time? But valuation alone is not enough. Uncertainty is always present, and that is why the final step is applying a margin of safety. This helps protect us from errors in judgment, unexpected changes, or the risk of overpaying for the business. This process highlights an important distinction that many investors overlook. That is, there's a difference between investing and speculation. Investing is when we buy an asset based on the comparison between the market price and the intrinsic worth of the asset. Speculation, on the other hand, is buying an asset with the hope that the price will increase due to any reasons which are unrelated to what the business is actually worth. That distinction matters especially if we choose to work with fund managers or asset management companies. Because even when you delegate capital, these skills still remain essential as they allow you to assess whether decisions are thoughtful, whether risk is being managed intelligently, or whether capital is being allocated with discipline rather than emotion. And finally, at the core of this approach is one simple belief that history does not necessarily repeat itself exactly, but in investing, it often rhymes. And understanding these patterns using fundamentals, valuation, and disciplined thinking is what separates long-term investing from guesswork. That is the framework that I follow and the one that I teach.